Hi, everybody. Welcome to the Mark Loeffler Experience. Thank you, Eileen Talik, for that wonderful greeting. I guess it is better than guys and gals. I don't know, though. You guys tell me. Comment down below whether you like, hey, everyone, or hey, guys, hey, gals. Who knows? Anyways, we're going to move forward. We have a great investor with us today, Jeff Borham from Tampa Bay.
Yes, sir.
Welcome, sir. Jeff's a good friend of mine, and we do a lot of different things together. And I look forward to having you on the show, and hopefully people watch this and get a lot of knowledge from this. And guys, if you guys want to see more stuff like this, comment down below who you'd like to see on here. I'll get them on, or what you'd like to learn from people who are coming on. And as always, please like and subscribe so you get notifications of when we have great guests on our channel. So Jeff, you're in Tampa Bay, Florida. We can see that. I mean, obviously the beaches are open there in COVID-19 and you're at the beach doing this.
Yeah, something like that.
Something like that.
Yeah, thanks for having me on, Mark. I appreciate it.
It's my pleasure, sir. Well, hopefully, I mean, you have a lot of great, well, I know you have a lot of great knowledge to share with everybody here. And yeah, so we'll just get into it. I guess the reason I've asked you to be on here, I know that you're a real estate investor. You're obviously a business owner. You own your real estate team, and you do well. We do some investing together in stocks and that derivatives and options trading. Number one, though, let's talk real estate.
All right, that's my favorite subject.
Well, I know, and you should own more of it, by the way.
I should own a lot more of it. Thank you.
That's right. Especially with how you can finance deals. And that's what I kind of want to talk about is, okay. So number one, let's just tell me, what's your portfolio? What are you doing down there?
Yeah, I mean, my portfolio is pretty simple. I own 18 single family residences and we are looking to grow that. I do have a business partner that helps me on the investments. And you know, we've set up a very unique financing structure. In fact, I pretty much created it with the lender that we use, a local community bank, which will enable us to grow that portfolio very quickly. And I'm happy to go into detail on that if you'd like me to.
Yeah, I will. By the way, it may be unique to that community bank. Yet I've talked to other real estate investors in the States and they get the same kind of deal.
Sure. Yeah, I'm sure we didn't create it. I just created it with this bank, you know, with the idea. Because I had talked to other investors that had done similar things. So I knew what I wanted. Now the issue though was finding the bank that would do it. So I interviewed over a dozen, probably 15 community banks, and none of them would do this. So I finally found a bank that would do it, and they had never done it before. So we literally did have to create the exact specifics of it as we went. And to be honest with you, some of the things that we discussed verbally aren't what showed up. And I had to go back to them and hold their feet to the fire to make sure they honored their deal and set up the loan structure the way we agreed to.
Yeah.
And they did. They did do the right thing, and it's a great loan structure.
Okay, so tell us, what is it? Like, because I know it's great. And I mean, as a Canadian coming down to invest in Florida or anywhere in the States, I don't think I can do it like you guys are doing it yet. I mean, people who are watching this in the States,
yeah, they can do it.
You can do this in any state too.
Yeah, you just have to shop and find the community bank that's willing to do it because they're out there. So what we did is, you know, obviously I'm a real estate agent, team owner. I run a top producing team in Tampa Bay, Florida, and buying investment properties was really just a entry level side gig. I was buying about one a year until really a year or two ago got more serious. So we had 7 or 8 investment properties that we started buying back in 2012. So literally like maybe one a year, maybe 2 on a big year. And these had decent amount of equity. And I wanted to, you know, be able to leverage that equity in order to buy more properties using a HELOC. So what I did is I basically just built out a simple spreadsheet to show the business model that we had for rental properties. So it was working. We had lots of equity, good cash flow. And when I found this bank, I sat down and I told them, what I wanted, and what I wanted was simple. It was a HELOC attached to a master loan facility. So we refied all of
So English, what's a master loan facility?
so just one big loan instead of individual loans per property.
So they do a portfolio loan. They put it's a blanket mortgage, basically. It's blankets every property you have.
Yes, sir. So we did a blanket mortgage. I'll use your terminology.
Yeah, I mean, master loan, blanket mortgage. It's more, I mean, I get what a master loan is. It's just more everybody out there, so they don't have to go to Investopedia to figure it out, right?
Sure.
Like,
no worries.
People aren't doing this every day.
So that's what we did is we refinanced out of the individual loans into one big loan. And because of the equity that we had in the existing portfolio, they attached a HELOC to it. So that's step one, is having the buying power in order to go buy new properties fast. Obviously, if they're distressed or need a quick close, you need to have cash on hand. Secondly, though, we had to be able to pull our money back out. So if you're using, in the States, if you're using a traditional mortgage, Fannie Mae, Freddie Mac bank, they're going to make you wait 6 months from the purchase in order to refinance it at the new appraised value to potentially pull money out. So
Which
I didn't want to have to
so
wait
bad, but that's, yeah.
Yeah, 6 months isn't awful, and yet I wanted faster because you can turn a house in a month, and if we can get our money out, every 4 or 6 weeks, you can obviously buy a lot more homes because, the HELOC obviously has a limit to it. So if you're using a round number, say you had a $1 million HELOC or a $500,000 HELOC, and your average rental property down here says, 200,000. If you had 2 or 3 going at once, you'd start to get tight on money.
Yep.
So if we can turn over the HELOC every 6 weeks, you can buy, 2 or 3 homes at a time every 6 and even 8 weeks, even being a little conservative. Yep. So I got that waived. So we can do immediate appraisals on our properties. So once we buy them, rehab them, we can do an appraisal immediately and put on permanent financing or more traditional financing. So we're using commercial loans. This is all a commercial loan, not residential. Mm-hmm. And most commercial lenders will do a 5-year rate lock. And I also negotiated a 10-year rate lock. So we're locking these super low interest rates now in for 10 years. And
so I mean, we're Canadian. Most of the people who have subscribed so far to my channel are Canadian, and so they get adjustable rate mortgages. I mean, we're 2, 3, 4, 5-year terms. They adjust to whatever's happening on the market at that time. I mean, it's a 25-year amortization.
Yeah. Most Americans are still not brainwashed, just they're just familiar with the 30-year mortgage.
Well, which is, I mean, I would do a 30-year fixed rate for the term the whole day long.
Yeah. Yeah. If you could lock in these rates for 30 years right now, that would be gold.
Yeah.
And you can, believe it or not, there's lenders here that will do it. The fees involved, and these are onesies, so it's not as ideal, I believe, as having one big loan with a HELOC attached to it, because you'd have to onesie them, which is fine. You would just need the funds or the HELOC attached somewhere else as you're refinancing them one at a time. So believe it or not, you can do 30-year fixed rate mortgages even here with these really low rates, but the fees and costs are going to be tremendously higher. So the other good thing about the loan program we have is that the fees are next to none. Every new subnote that we add is only a $500 administrative fee to the bank, and then any fees that we need to do an appraisal, survey, and so forth. So there's really no additional closing costs every time we buy a house.
So, I mean, let's walk me through a deal.
Okay.
Walk me through, like, when's the last time you closed on one?
Last month.
Okay. Walk me through it.
Yeah. So the last house that we bought, let me just refresh my memory real quick so I can give you, I like to give accurate numbers. So this is an interesting one. So this was actually a wholesale deal. And
so you wholesaled it, or you bought it off a wholesale?
So it was a wholesale deal, not me. So there was a wholesaler that had it, and they were not able to flip the contract, believe it or not. and they were buyers on one of my listings.
Okay.
So they needed to sell in order to buy. And when I heard that the transaction fell out, I said, well, let me look at it. Maybe myself or maybe an investor that we work with might be interested. So what's fascinating is I ended up buying it for less money than what the wholesaler had it under contract for, because the buyer just wanted to sell in order to buy their new residence.
Mm-hmm.
And this house, we literally only had to put $2,500 into it after we purchased it, and we bought it for $125.
Okay.
And we've now put $2,500 into it, and it rented for $1,400. So we're getting a $1,400 a month, long-term 12-month renter, and that's a cash in of $127.5. It appraised. Now I might be slightly off on this. I think it appraised for so the way this works is we attempt to do these deals that we get all of our cash out, but we actually got a loan amount of $120 out of it. So that means it appraised for $160. So we bought it for $125. We put $2,500 into it. It appraised for $160. So we were able to pull $120,000 back out of it. So our cash into the deal is $7,500.
Plus your fees and whatever, so maybe like $9,000.
Yes. Yeah. So
Okay.
$7,500 straight into the property plus the appraisal, survey, and $500 fee. That's pretty much exactly right. Yep.
$9,000. Yeah. So okay. So walk me through what's your mortgage payments on a $120,000 mortgage?
Well, that one got locked at about 3.6 or 3.7%.
That's not bad.
No, not on an investment property. You're kidding? So the mortgage payment for principal and interest is about $700.
Principal and interest, $700. Okay.
Yep. So the other expenses that we have is property insurance is about $600 a year.
That's pretty cheap, actually, $50 a month. Okay.
Yeah. And then we added to a liability policy, but that's a group policy. So that's like $50 a year. And then property taxes on that will be about $2,000 a year. So I round up, say $200.
$200 a month. Yeah.
Yep. So, and then we do use a property manager. So the property manager fee.
What's that, about 8%?
I actually pay less. So I pay 5%.
Okay. So $70.
Yeah. So $70 plus 200 is 270 plus 50 is 320.
So 1,020 plus you got some maintenance costs on there, vacancy. So if you did a 5% vacancy, $70.
Yep. So it's going to cash flow. When I did this deal, I said it was $300 a month cash flow.
Yeah, even with vacancy and maintenance, you're still $100 or $240 a month cash flow.
Yeah. And the numbers might be slightly high because the mortgage might be less, because I did the math when I bought it, and it was right about $300. So,
Okay.
and the great thing about this is obviously we bought about $30,000 worth of equity on the way in. So we got a 20% appreciation at purchase.
Yeah. Well, so I mean, let's run the numbers. I mean, even at $250 a month, at $3,000 a year cash flow, $9,000 in, that's a 33% cash on cash return.
Yes, sir.
Yeah. And you have $40,000 in equity sitting there. Let's call it $30,000 in appreciation over and above your costs and everything. And you have $9,000 in. So that's 333% per year. And then you got a little bit of mortgage pay down, but why are we even going to calculate it? You're already at 366%.
Yeah. Well, you know what the scary thing is, Mark, is this wasn't even one of our better deals in the last year. So we have deals that make these numbers, are way better than this.
So my question is, how come, why aren't you buying 10 of these a month?
That's a great question. And I think I need to figure out how to do that, because there's obviously massive opportunity here. I mean, there's real opportunity to make significant money, and, there's a lot of competition, and yet they're still out there. We can do it. We just have to figure out how to do it.
Well, what's holding you back? Is it money?
No, I mean, we have the money to do, like I explained to you, even without coming out of our pockets. We could do 2 or 3 every 6 weeks, just with that mortgage facility that we have. I think I just need a good mentor, maybe someone like you, to show me the ropes.
Well, we can make that happen. Okay. Well, I mean, that's why I wanted you to share the numbers. Because I mean, to be honest with you, if you're in the States and you're not doing this, because like these opportunities are everywhere in the States. Like for me, I mean, I get excited on, you know, I buy my apartment buildings, I get all my money back within 4 years, and I own a great asset. I mean, it's stable, it's in Canada. I mean, this is why I'm looking down there, because I think there's just, even in the multi space, there's that much opportunity.
Yeah.
And I mean, your tenant rules down there, I mean, they're a lot less than they are here for me.
Oh, I'm sure they are. Yeah. Yeah, no, and we're selling you some multifamily places. I think there may be some opportunities coming up soon.
I hope so.
Yeah.
Well, I mean, yeah.
Well, listen, in every situation, COVID is going to cause opportunity, just like any other, you know, negative event, if you will. And most wealth is created in downturns, not upturns. And not that I think we're going to have a big downturn here yet. There's going to be more opportunity than there was 6 months ago.
Now let's go to Permabull, Jeff. So, I mean, obviously real estate, this is like exciting. And here's the thing, you don't have to use any of your own money to do it.
Yeah, exactly.
I mean, you have to use some of your own money to get in and get going.
Yeah.
Get started.
Get it started so that we at least had enough houses with some equity. Now you can mock what we did and, you know, use a home equity line or have a credit line set up, you know, or even start with cash and then pay yourself back. If you buy right, you know, you can pull your money back out even if you used your own cash, and then, you know, go from there.
Yeah, and to be honest with you, even if you're doing 5, 6, 7, 8 of these a year,
it's a lot of money.
That's a lot of money, and it's a lot of wealth being built over time. Because I mean, I don't know if the properties are like they are here. I mean, are they appreciating every year?
Oh, I mean, they have been, sure, certainly.
All right, and historically, you're going to appreciate every year. I mean, you're going to have up years, you have down years, but it's probably 3 or 4% a year.
Yeah. Well, that's what I explained to, you know, our investors, the people on my team. What's awesome about real estate is you're making money 3 ways, because, you know, we only buy cash flowing properties. So, you know, you're cash flowing, we have mortgage pay down, and we have appreciation. And I don't know any other asset class that pays you 3 ways at the same time.
All right. Again, we're going to go back to Permabull, Jeff. So Permabull, Jeff, tell us about, because you've been investing in stocks and all that for a while, right?
Yeah, I mean, I was raised by a financial advisor, so it's kind of in my blood. When I was a little boy, I'd wait for my dad to come home so we could watch it was probably CNN Business back then. I don't think it was CNBC, but I would love to watch the ticker with him and, you know, hear about the business. So I've been trading pretty much since I was a teenager. When I was 15, I actually turned $2,000 into 40 grand buying some tech stocks into the tech bubble. So that was fun.
How much did you lose though at the end?
I got out probably with about 10 grand. So I think I lost about 3/4 of it. Because, you know, I had it all figured out. I was 15. I knew what Mustang I was buying. I mean, I had it all set up.
And what'd you have to get after that? A Pinto?
I bought a 1996 Ford Taurus for $5 grand.
Obviously, you've been investing for a while. I know I've talked, well, it's been what, just over a year now?
Yeah, February of last year is when we had that first talk.
Yeah, so February last year, I introduced Jeff to Lee Lowell and Derek Foster. Did you read Derek Foster? Or did you just read Lee Lowell?
What's the PDF that was in the group?
Lee Lowell, yeah. So Lee Lowell has the book Get Rich with Options. Guys, I'll put a link down below. If you guys, yeah, I'll put the link down below. You guys can go grab that book. You had a pretty good year last year, right?
Last year I was up 73% in that trading account.
So from basically the end of February till the end of December, you're up 73%.
That's correct. Not bad, huh?
Not bad, not bad. And I mean, I think you're riskier than I am.
Oh yeah, well, and I got beat up a couple months ago, fine, but my account has recovered significantly already from then, and I've learned a lot. So, you know what?
These last 2 months, or last month and a half, has really been like I've learned a heck of a lot more. I've refined my trading strategy even since then. Yeah, and guys, I'm going to do a video for next week, probably Wednesday, on how I trade. I'll show you one of the stocks that I bought and I did some options on, and I'll just show you my performance on that. And yeah, we'll go from there. So guys, again, like and subscribe so you can get that notification. So, I mean, let's talk. So what do you do in the stock market? What do you do to get a 70% return per year? So, I mean, real estate, you're getting over 300%.
Yeah.
Stock market, you're getting 70% plus.
Yeah, it's not bad, right? So,
I mean, are you just a wonder kind, or can anybody do this?
oh, yeah, no, anybody can do it, because trust me, I made plenty of mistakes last year and still made 70%. And, you know, I made plenty of mistakes this year with the downturn, and my account, you know, like I said, I learned so much, and I'm a much better trader today than I was last year. So if we had a year like we had last year in the stock market, again, I'll make even more money because now I know how to trade better. What I did last year was sell puts on companies that were in upward trends that I liked, you know, so, you know, Apple being a great example, you know, Microsoft, things of that nature, you know, a little bit of aggression here or there with a Tesla or an Nvidia, and yet, you know, those are still, you know, great companies at the end of the day. So I would never sell a put on something that I think is, you know, going backwards in their life cycle of a business. So I want to sell puts on companies that are, you know, obviously growing still, and companies that I would want to own for the next 5 or 10 years, because there are times that it gets put to you if the stock has a pullback. And while you can get out of the option if you want, or you can have a stop loss to bail on it, you may just want to buy it and then trade the stock as well. So I still do like to buy stocks, you know, straight out, you know, on pullbacks. You know, today.
So I'm just going to stop you for a second.
Yes, sir.
We're going to pause. You said a lot there. So I just want to clarify that the number one thing you were doing last year was called naked puts, correct?
Absolutely.
And a naked put is essentially, for everybody out there, is you're selling insurance. So for instance, Tesla. On Tesla, you sell a naked put for, let's just call it $500 for sometime in the future, 6 weeks from now. You get paid a certain price. They give you the money. So you're selling them the insurance, and you're basically insuring that person who's bought that off you, that if it's below $500 at that time, you're going to buy the stock, right? So basically, when you're selling a naked put, you're selling insurance. Obviously, this works well in an up market, because if the price of the stock goes up, it just expires and you keep the money for insuring it, correct?
Absolutely.
And obviously, in a down market, you get put a lot of stock. So, I mean, tell me what you're doing differently now that you weren't doing last year, and what would have changed?
Yeah, well, now I, you know, last year was pretty much selling puts and buying stock outright, and this year is still selling puts here or there, but definitely picking my moments. For instance, I do have a Tesla put out right now for 400 though, and the stock, I don't know where it closed at today, but it was around 700. Yeah. So obviously a big, you know, cushion, and, you know, I don't know how detailed I should go, but when VIX is elevated, the payments are much higher, so you can sell.
So I'm just going to clear. So we use a lot of terminology, right? So the VIX is the volatility index. So the higher the volatility, the higher we get paid to insure something. Because I mean, it's the same thing. If you're a bad driver, you have lots of points, lots of accidents, you pay a higher rate.
Yeah.
So with the higher volatility, the chances that you could hit the strike price, the $400 on Tesla or $500, that you get paid more.
Yep.
So sorry.
So definitely doing some puts, but shorter time periods than I would have last year. I'm also buying and trading in and out of the market when I have time. You know, for instance, you know, if I see a stock that I like Nvidia, have a big pullback like it did today, you know, I'll buy some shares, but I'm not going all in on it. So instead of buying, say, 100 shares, I might just buy 50 shares today. And then if it goes down again tomorrow, I'll buy more. And then when it pops, I'm getting out of the trade. So I'm riding momentum on quality stocks, and I'm also selling naked calls as well. For instance, yesterday Tesla was up somewhere around 750, 760, and there was a Friday call at 1,000. Now Tesla's never been at 1,000 in the history of its stock, and it was at 750 yesterday, and I got paid $250 to sell a naked call for Friday that Tesla wasn't going to get to 1,000 by Friday. So now I'm trading stocks, that I like. Again, this isn't just like any stock. It's got to be a stock that you don't mind owning, and playing the momentum, because if the stock goes the other way, I want it to be a stock that I don't mind holding and riding that wave. So when I buy a stock outright, I'm not really going to bail on it unless, I had to. Generally speaking, there's stocks I'm going to buy and then sell for a profit, no matter how long it takes. And then when a stock like Tesla is up at 750, I'll sell a naked call and or put down at 400. So kind of bracketing the stock in these ranges. For instance, I also did the same thing with Roku. Roku was at about 125, and I sold a naked call for 170, and I sold a put for 95. And I think I did that from May 8th. So I went out about 2.5, 3 weeks. And I said, Roku's not going to get to 170 within the next 3 weeks, and it's not going to go below 95 in the next 3 weeks.
What'd you get paid on that?
The total credit was about $600. So the only way to get hurt on that is if the stock went below 89, or above 176. So you'd break even if the stock went to 89 or 176. And Roku's never been at 176, and while it's been below 89, it's much more in favor now with the whole COVID and the whole stay at home. So the likelihood of it pulling back, 36 points is pretty limited in the next 3 weeks.
So, we just talked a whole bunch of gobbledygook for a whole bunch of people.
Yeah.
So tell them, what would you recommend to getting started if you're thinking about getting into stocks, or getting into doing some options trading, that type of thing?
Well, the first thing to do is to surround yourself with other people that are doing it and doing it well. So, there's plenty of groups on Facebook. There's plenty of groups, on WhatsApp and different places. So, just start hanging out with people that are doing it, see what trades they're doing it. And then obviously, if you want to do it, put your toe in the water and maybe copy one of the guys in the room that you like their style and figure it out. There's only one way to learn in this world, and that's to do.
Yeah.
So if you want to trade, you have to trade.
There are a couple books out there that's
you mentioned them as well. Yeah. So you should definitely read those 2 books from Derek Foster and Lee
Lowell. Yeah.
Lowell. Yeah. That's a great place to start. And then surround yourself with people. It's the same thing in any industry, whether it's real estate investing, stock market investing, selling anything. You should talk to people that are doing it at the level that you want to do it.
Or higher.
Well, that's why I hang out with you, Mark.
Well, to be honest with you, you guys do on the trading stuff, you guys do way more fancy crap than I ever do. I'm simple. I should just be called the simple investor, because I do my naked puts, I do my covered calls, I buy stock. I do some naked calls on some stuff too, not as much as you guys, I don't think. Yet I like to keep it simple.
As long as you're making money.
So let's talk about that. So one of the things I get all the time is, I don't want to day trade.
Mm-hmm.
So how much time did it take you last year when the market was good? How much time were you spending a day doing this?
Last year?
Yeah.
20 minutes.
20 minutes. Because, you sold how many homes last year with your team?
234 properties.
234 properties. So you were busy. You have a team, you run a business, right? So, yeah. Okay, let's fast forward to 2020. We're in COVID world. How much time are you spending a day on this?
I'm looking at my phone app more, but as far as actual looking at the screen and really doing it, 30 minutes.
Yeah. I would say I'm probably up to, it depends on
my phone app, you'd probably say some people are addicted to checking Facebook or text messages on their phone. I'm probably addicted to like, doing that quick like glance at my phone every so often.
So let me ask you this, like, are you, do you Jones on weekends too?
Oh yeah, no, I mean it's definitely a little bit of an addiction. I'd say that I've done a pretty good job of turning everything off. I think from running a big real estate team, you learn to turn it off when you're not there. Otherwise, you're go insane. So
Yeah.
I think I'm already naturally pretty good at turning it off. But yeah, no, I definitely get the itch, but it's not like full on white knuckling, if that's what you mean.
Yeah, yeah. Well, I mean, that just happens on 3-day weekends for me.
Oh, on 3-day weekends or 4-day weekends, you're definitely like, okay, when's the stock market opening? Because we just had that with Easter. The stock market's closed on Good Friday, and yeah, no, by Sunday I was definitely looking at my phone, going, really? It's been 3 days.
Yeah, yeah. It feels like we should be trading.
Yeah, exactly. Yeah, but it's really not a big time commitment. And if you're spending more time than that, you're just looking at your trades versus, I mean, you're not actually trading. And as far as like the research element of it, I probably do, but I always did it anyways. I mean, I was already, listening to CNBC on the radio, or already looking at some stock charts on the weekends or evenings because it's a passion of mine. So I haven't increased that any. It's the same as it always has been.
Well, that's funny. Like, I don't even look at stock charts. I mean, I have a basic understanding of them. I just know that I mean, I have probably 10, 15 stocks that I like, and I basically just watch them like a hawk. So I know them.
Right. Yeah, you've got a feel for them.
So, I mean, that works for me. All right. Well, I mean, so we've talked real estate, we've talked stocks. Anything else you think we need to cover before we end it off, or?
Well, I mean, I would just quickly add, I mean, you should definitely diversify if you can, if it's an industry that I mean, I have other investments in other businesses. I know you do as well. And we want to make sure that we're not spreading ourselves thin, and yet you're doing verticals, if you will. So, for real estate, for instance, owning a title company makes sense. Owning a property casualty insurance business makes sense. Owning a property management business owns sense. So just think big about what else you can be involved in, partnering with a real estate investor versus doing it yourself. Like, it's better to own, half of 100 units than to own, 100% of 10 units. Yep. So look for those opportunities to partner, potentially, because you don't have to own the whole title company. You can own half of a title company or 25%. And I'm just using that as an example, because I happen to own, half of the title company.
Yep.
So, those are the things that we should be looking at is what opportunities and where can we drive business and what else can we be involved in.
Yep. And I mean, you probably partner with somebody on the title company that is good at what they do on the title company, and it's really just passive for you, and your only job is to feed maybe a business or do something like that, because that's what you're good at.
That's exactly right. My job is to drive business, give some business vision, overarching stuff, and they're the one running the business.
Yeah. So I mean, it comes back to everything. I talked about in the joint venture thing. I mean, you're just joint venturing with them, you're partnering with them, and you're going and finding people who have skills that you don't have to grow businesses. And, obviously you're using their time and expertise to grow that business, because you're using your time and expertise to run your real estate business, invest in real estate, also do trading.
Exactly. And then when you run into people that do a great job and it makes sense, you can get into business with them.
All right. So, I mean, I guess my top takeaways from talking to you is, obviously, number one, look for leverage.
Yes.
Right? Find those people you want to partner with. Number two is that the U.S. has way better style of investing than we have in Canada. I mean, it's a lot tougher, a lot tighter. Number three, I mean, I want to go down to the beach there. I hear the beaches are open there.
Yeah, no, our beaches are not open yet, believe it or not. And they will be soon, though. So the state of Florida will likely be opening up within a couple weeks. So you're welcome to come down.
Knock on wood. Hopefully that's not too soon.
Hey, I just roll with the punches, my friend. We're you know, we're in the COVID, it's April, it's, you know, we've got COVID and we put 8 properties under contract this past weekend on the real estate sales team. So all we can do is keep doing what we can do.
That's it. We just keep moving forward and be kind of a ground in this uncertainty, right?
That's it.
Good. All right, sir. Well, everybody, if you guys like this, I'm going to put Jeff's contact information down below. If you guys want to buy some properties in Florida, give him a shout. Tampa Bay. I'm going to link the books down below. And guys, you know what? I'd love it if you could subscribe and like the thing. We're up to 230-ish subscribers as of the time of filming. And you know what? Love to, I mean, the goal is to get to 1,000 as quick as possible. So if you know anybody that might like this, if you could share it with them, greatly appreciate it. All right, guys, see you in the next one.